name is Daniel,
Hi,
and we have
folks.
with us Dr. Rowe once again. And we're really excited to have Dr. Rowe back with us to continue the second part of this series on new build properties or off-plan properties versus existing properties, meaning they're already built. Or other people might know them as resale properties. So if you haven't already watched the first part, check out the video that's over here. That will tell you, what are some considerations when you think about new build properties. And I think for a lot of us in Asia, Dr. Rowe, just to share with you a bit of context, that when people think of property investments, they often think of buying, off nice glossy brochures and selecting a
Yeah,
property.
right.
And the agents also will be selling them those because they just stand there and wait. There's a homogeneous many units, and they can sell many units at a go.
Mm.
But from an investor's point of view, it may not necessarily cash flow. I mean, that's where we
No,
kind of left off
I
on the
mean,
last
I
conversation.
think just adding on to that as well, I know you mentioned in Asia, it's also the case in a lot of major cities and where there's more capital that people have, high earners. And for a lot of the time, they like the idea of buying something that's kind of from a glossy brochure. It looks good. It's freshly developed. In their mind, they're buying something new. It's like, we look at it as retail, as investors, but they don't necessarily see it that way.
Yeah.
So I agree. I think it's definitely, having been over there, it's definitely a big, it's a strategy for a lot of people there. But it also, if you go to London, it's the same thing. They dangle all the brochure, how it looks, but there's so many other hidden costs which we talked about. And that's another factor actually we haven't discussed briefly, is that when you're buying an off-plan deal, those of you watching, be mindful that there's often a lot of hidden running costs. So here
Absolutely.
in the UK, for example, you have management costs, you'll have service charges and ground rents. So whereas if you buy an old property, an existing property, you buy the freehold, you own the whole asset. Here you're just buying that apartment in a block. So when you start doing your cash flow, they can often negative or even be zero, at best case zero. So you have to be mindful of that as well.
That's right. And we have someone joining us live as well. Welcome to join us. Feel free to type in your questions if you have. So we're going to go on to existing property. And I think it's such a good point you're making, Dr. Rowe, because a lot of amateur investors, without knowing how to assess, risk versus reward in the investment, they think that it's a safer bet if they will go to, go to a developer, and maybe go through a estate salesperson, because they just don't know how to qualify an existing property.
Yeah, it's an easy ride, It's handed to them on a plate, but you're going to pay premium for that. Not just the price, but also potentially the risk of the cash flow not working.
Absolutely. So I mean, that's where I think a lot of people come to us, and over the years they say, "Oh, I bought property, in London or in Manchester, but it's a studio or it's a 1 or 2 bed flat." I think in the last video we spoke about how that property is maybe. I think I shared about a case of a 2 bed flat in Manchester costing some $250,000, and there was also this other new build about, I think it was a hotel room, sold for about 100 grand. And it comes with a 10-year guaranteed rent. Remember, these are like the red flags we spoke about. 10-year, I think 10% guaranteed rent for 10 years. And the amateur investors' eyes light up, but not realizing that this guarantee comes from the developer of the profits that they're making. Because, 100,000 for a small room, you pay a little bit more, you could get a house.
Yeah, but also that's a good point, actually. If anyone's watching this, remember, whenever you go into a property, you also have to think about how you're going to get out of the property. We just had a discussion about that before the live, just looking at a few UK opportunities. And we always look at the exit strategy as well. So you got a room. What if you've just bought a room for 100,000 and there's another 100 investors have bought that room for 100,000? Now, at the end of the 10 years, what happens next? Oh, I'll sell it for 120. Yeah, but what if everybody else wants to do that? So you're back to this whole problem about suddenly you're going to get 50 for it.
Yeah, and I think a lot
and that room would have been, the hotel will be dated as well. So now it maybe needs upgrading. So it's be careful.
Yeah, and there's some gimmicks thrown in about guaranteed buybacks at like 5% more than what you paid for it in a certain amount of time. But this really is as good as the word of that one developer. So for us, I love what Dr. Rowe shared about managing your exits. So having one exit is important, but what is your second exit? And those of you who are taking notes, you might want to write this down. You want to make sure you have at least 2 exits. So one could be maybe a developer, but what is the other exit? Could you sell it on the open market? What would it be worth? Yeah.
That's a good way. That's a good segue into looking at existing properties, actually. So, I mean, just tagging on to what Daniel's saying there, that the next stage, so let's flip and look at the other side now, existing properties, 100 years old, 200 years old, 75 years old.
Yeah.
As a rule of thumb, when a property is built, certainly here in the UK, you could be looking at 6 to 7 to 8 years before it really finds its true stable market value. So when we look at a property that's 50, 80, 100 years or more old, we know that its price is its price. You know, it can't suddenly appreciate above everything else, because all the houses in the area were built at the same time. They've got a history behind them. They've had their rises and falls. They've gone through the economic cycle.
Yeah.
So you're getting a genuine market value. The only way you could force that up is by adding something to the property to make it unusual, but you can't make it so unusual that the price suddenly doubles, because no one will value it at that as well. So you get a much more accurate valuation. That's the first thing I like about existing properties. Yeah. And the second thing, just before you jump in, Daniel, is that when you look at existing properties, you've got multiple exit strategies. So we might look at a property to rent to students, but then equally we could rent to working professionals. I could do it as a family let. I could rent it to the government. I could rent it to multiple tenants and make it a house of multiple occupation, or I could sell it to a family if I want to cash in. Multiple strategies.
And I think what people don't realize about this multiple strategies you're talking about is actually it lowers the whole risk profile of the investment, because you know, if one strategy may not be working for whatever reason, you have many other strategies that you could work. You know, you could sell it, you could rent it out. And I remember this thing that you shared with me years back about buying average houses for average people, right? The man on the street. So a lot of people, when they think about investing, they want to buy, you know, a prime property, you know, say in central London, even if it's an existing property. But these are, you know, in times where there's a recession and we see a lot of expats and losing their jobs, companies, you know, tightening their belts, then guess who's going to live in these properties? It's going to be the expats are going to be gone, or their rent budget is going to get cut. Whereas if it's a property that is for the average person on the street, once again, it's the same idea of many exits, right? You have many people that can rent your property from you.
Well, actually, you had the same situation in Singapore. There was a period where a lot of the big corporations started to pull back a little bit from Singapore, so that changed the buying market, but also the government, I think, capped prices or restricted who could buy, so that made it more challenging, didn't it? I seem to remember.
Yeah, there's basically restriction on or basically additional stamp duty that foreigners have to pay.
That's right, yeah. So I think this is a very good point. So when you're looking at existing properties, yes, you're buying something that's older. It's like buying an older car. So you have to accept with that. There's likely to be more maintenance, and you've got to allow for that. But we factor that in. So if, for the sake of argument, there's £15,000 worth of work, and you know that, you're going to bring the price down. You're not going to be paying a premium price like you would with a new property. Yeah. Brand new development, they're going to argue that it's brand new, so they upload the price. Whereas an existing property, you can go in, you could look at 10 properties within a same area, within a 5 to 10 minute walk, and you could put 10 offers out there, all of which are low, because if you do statistically, you know one of those is going to come back with a discounted price, and now you're in here, you do your work on the property to bring it up to a good standard, and then you increase the value as well, and then we rent it out.
And that's
a lot
a great
more
thing
flexibility with an existing property.
And that's a great thing you can do with property, right? Because let's say other vehicles like a stock, you know, there's very much there's very little rather you can do to increase the value, and it's very much dependent on the company and the management. Whereas with a property, you buy a property, you could give it a new lick of paint, you could do some refurbishment, and that would add value to the property as well. So I think when we were walking the streets with some investors, when they came over to the UK with us, looking to build their portfolios, that's when we looked at existing properties, and immediately you get a feel of the area. But at the same time, you know exactly what it's going to rent in terms of cash flow, because you can then do your work. However, that said, I think existing property investment is not a strategy for everyone. It's for someone that, you know, is prepared to get themselves educated, you know, put in the work, or leverage off someone who already knows how to do it, so that you can.
I think you've raised a good point as well, Daniel, because it's one thing to buy remotely, and I know you do, and that's because you've been over enough times. But what I love is, as you said there, is when we're out with people, they fly over, we spend time, we sit, talk to them, and they get to see a real deal, and they can see how the numbers work, they meet the teams. And as an investor, the minute you can see and meet and touch the whole market and the people involved, you can step back from it, and now you can be more remote.
That's right.
So there's different stages to that. There's the education leading up to making that decision, and now I'm going to go and look at the market. But you don't have to keep flying backwards and forwards every month.
No.
I don't drive up and down to the north every month, and yet I can still buy properties. Some of my properties are 7 or 8 hours away from where I live, but the teams are there. So it is a staging. You know, the fear will stop people even walking through the door.
Yeah.
But education, what education does, it strips away the fear, and it makes us much more aware of what we can do. And then we.
So I think Dr. Rowe just dropped off there, but what he was saying is that education strips away the fear so that we have a lot more clarity and confidence to make our investment decisions. And what's funny is he said some of his properties in his portfolio are like 7 or 8 hours away from where he lives, and it's in the UK, maybe in the north. But, you know, I'm living in Singapore, and the properties are maybe, you know, like 13 hours away, which is 5 hours away. That's nothing at all. And we live in such a globalized world now. It's about investing where your strategy works the best. So I think if you're listening to this, you might want to think, how serious are you in terms of building a property portfolio? And the reason for us, if you haven't watched some of our earlier videos, the reason why we believe existing properties are better than new builds is the rent that you can get for those properties is going to be much higher than, or at least on par with the new build properties. However, the new build properties are going to cost much more. So in terms of a yield basis and cash flow basis, you're going to be paying much more for a new build. But what your real goal is actually the cash flow and the rent. So we were just talking about how you know, your properties are 7 or 8 hours away, and for me, from Singapore, it's maybe 13 hours away. So it's actually not that much of a difference. And it's about investing where the strategy works best.
Yeah, I mean, I've got stuff within an hour, but others, like I say, 7 or 8 hours away. And there's an important factor, and that's not to be emotionally attached as well to this. So it's a business, and you have to treat it that way, and allow, you know, when we do the calculations for cash flow, we allow for that slippage in the movement. We build in operating expenses, and that's the buffer. You don't have a lot of those, you know, on a new build property. There's no margin. I mean, literally, there's so many running costs, which people don't. People think because I'm buying an older house, it'll be more running costs. But actually, if you buy an old house, which is we would call it, I think you call it a landed property, I think maybe, where it's, you know, there's no title. You own the title, everything. You own the asset.
Yeah.
Where the new development is a lot more challenging because you're buying a piece of a big block which somebody else owns, manages, looks after.
Yeah.
So you have all, and they can make those costs can be significantly high enough to kill the cash flow on the property.
That's right. Absolutely.
That's not to say all existing properties work. So don't make the mistake of thinking that what we're saying is all existing properties work. That's not true, because some existing properties don't work at all. I can take you to areas where, I mean, Daniel's seen this for his own, you know, with his own eyes. You can go to one area, doesn't work. 10 minutes away, there's an area that will cash flow for you 500 Singapore dollars, 1,000 Singapore dollars a month.
Yeah, and I think property is so street by street, which is why you really need to have someone who is an expert to, you know, walk alongside with you, because you could think you're buying a good deal, but you know, just one street away makes a world of a difference. So I mean, we've been going on for almost 13, 14 minutes, and I just wanted to round up to say that you know, from Born Poor Die Rich, Dr. Rowe and I, we have a gift for those of you who are tuning in. And also those of you who are going to watch this, which is we have 3 tips that you should consider before you even make a property purchase. So if you are keen to find out about that, you know, just send me an email at daniel@bornpoordierich.com. So it's daniel@bornpoordierich.com, and we'll be happy to send you those tips, and it's completely free of charge. It's for you to be able to make better decisions, you know, just watching this video. And of course, you want to take that further to get yourselves really educated in terms of how do you analyze any deal from anywhere in the world. You know, we are here to help you with that as well.
What would be great as well, if now you've got that email, is to ask the questions that we can address here. You know, when you get me on, we can tackle those tough questions as well.
Absolutely. So great. Thanks for having you know, being here with us once again, Dr. Rowe. And for those of you signing in, remember to send us your questions, drop me an email. We'll be happy to reach out to you, and see you on the next video.
Brilliant.